Without further ado, it's my pleasure to now introduce our next keynote speaker, Kaushik Saha. He is the CEO and co-CIO of True Risk Capital, an institutional investment researcher, portfolio manager, and trader. It's lovely to have you here with us today. Highlights of Mr. Saha's, Kaushik, is it Saha or Saha? Saha, thank you very much. Highlights of Mr. Saha's career include systematic model development and portfolio management at Barclays Global Investors. He is a past pioneer in scientific investment research, an industry leader in data-driven systematic hybrid investing and active portfolio management. True Risk Capital is a quantitative manager of liquid alternative hedge fund strategies that circumvent the constraints of legacy investment styles in traditional asset classes. The firm's algorithms automate a research-driven systematic approach, which is non-discretionary, in offering clients for its US equity, long-short, managed futures, and equity index option income strategies. Mr. Saha, it's lovely to have you with us today, and the floor is yours. Thank you.
Thank you, Roxy. Pleasure to be here speaking at the InvestTech Innovations Conference today. Hello to everyone, and very thankful to the Deep Knowledge Group for the opportunity. My name is Kaushik Saha, and as Roxy mentioned, I lead up the efforts at True Risk Capital. True Risk Capital is a quantitative investment manager that's based in Los Angeles in the US. And our specialty is that we use a systematic approach using machine learning based methods as well as traditional methods in investment finance. The highlight is that we take a completely non-discretionary or fully automated approach and let our machines basically make the investment decisions and basically produce investment returns. So today I'm going to share with you a slide deck that talks about the machine learning methods we use for algorithmic trading for our True Risk Capital US equity long short strategy. Strategy offering, as I said, we implement a quantitative investment methodology, and to build and trade an investment strategy, there are three parts to it. One is the prediction portion of the model, where the various signals are basically predicted over a certain time frame. It could be 3 months, 6 months, 12 months, using various machine learning methods. And then there is the second step, where the outputs of the prediction models are combined to create tradable ideas, whether you want to buy IBM or sell Google, those sort of decisions. And then we have to do a back test and then a live simulation to determine whether these market calls are profitable. So let's see, next slide. As I mentioned, we focus on US equities with a market cap greater than 1 billion USD. They belong to the Wilshire 5000 index. We have the ability to go either long or short. Proprietary quantitative investment methodology. Our position count is typically 100 securities, 50 long, 50 short. And we rebalance typically every month. And of course, as the market moves and the security prices move, we can implement stop losses and so on. We can take profits, so that can be at a faster frequency. And then we have a market bias, plus or minus 15%, depending on which way we think the market might move. We have a trend indicator separate from our machine learning methodology that I'll dive into right now. So as I mentioned, we focus on the prediction aspect using our artificial intelligence models. And then we move on to portfolio selection after the predictive analytics have delivered on their recommendations. And then Portfolio management involves risk management in large part so that there are no imbalances. These are the checks and balances which any market-based system will focus on. As I mentioned, the calls are made in a market-neutral approach so that there is no bias between the long and short recommendations initially, and then we apply the external bias depending on what a trend indicator tells us. So the prediction layer is based on fundamental data, as you would expect, company ratios, and then alternative data. So fundamental data, obviously, you'll be familiar with. It involves focusing on income statements, balance sheets, cash flow statements, so on and so forth. And alternative data is a whole host of other things, mostly relating to sentiment, market sentiment. And then we have a portfolio construction layer, which I talked about, market neutral approach. And as I mentioned, 50 longs, 50 shorts, covers about 3,000 equities. And then the risk management layer implements a granular stop loss system. So these systems all work hand in hand. And obviously with any system, there's a feedback loop that is self-adapting and self-aware because of this AI-based approach that we take. So a lot of our process fits the traditional mold. Like any traditional process, you'll have your data source, and the market data will be either traditional or alternative. And then we have the model that is implementing these sophisticated, logical decisions based on machine learning methods, which I'll go into next. And then we go back to the traditional approach of execution and monitoring. Basically, this optimizing for prediction accuracy that we take on using our algorithms reduces the bias and variance in supervised learning, and basically gives us a chance to convert a family of moderately strong learners into a strong and robust one. The choice of the method we use based on any data set that we focus on depends on the structure of the raw data. And again, we go through a process of cleaning up the data to ensure accuracy before application. And then, as I mentioned, the predictive layer of these models, they work in a feedback loop-oriented method so that they adapt to changing conditions and adjust in real time. What are the AI models we use? There are obviously various types of AI models. There are your typical basic linear AI models, the most fundamental of them being logistic regression. And a lot of this is obviously based on statistics, comes out of the field of statistics. Then we use linear discriminant analysis, Bayesian regression. And then there are nonlinear AI models, which allows for changing of the parameters as and when the underlying data changes. So we have k-nearest neighbors, random forest regression, and support vector machines. And then advanced nonlinear AI models. And again, these are growing, and it even includes, genetic evolution algorithms, which I've not put down here. So it's a long laundry list. And so we have built our libraries of these our own proprietary implementations of these various approaches in machine learning, and we apply them to our data. So the first stage of evaluation in this predictive phase involves 65 unique fundamental factors and ratios across two timescales, daily and quarterly. And we then create a subset based on this first stage of evaluation, where in a second stage, we apply 20 unique technical metrics for an equity. So each equity of the, each of the 3,000 equities that we're evaluating, we'll apply typically in our second stage 20 unique technical metrics using, optimal entry and exit points for each position. So, with every sort of change in day-to-day price, we will reevaluate all these metrics all over again. So third stage of evaluation utilizes price predictions of 3 months, 6 months, and 12 months for each equity, as well as volatility predictions using the same time scales. So that's how we narrow it down to our selection subset. Next up, we after the initial evaluation phase, there are a large amount of equities not suitable for investment in the current time. And so we discard them, and we then basically focus on our proprietary C-score system, which is basically a core value driver of alpha generation. So this C-score system looks at the risk reward profile given all the signal inputs that it has received, and then generates the buy and sell decisions for each of the selected securities in our prediction layer. So the C-score system is designed to optimize sector exposures, both on the long and short side, and is basically the core driver of our returns. So this is essentially what goes into creating, a robust portfolio, that we either recommend to investors or implement ourselves. So I won't really dive into, the C-score system because time is short, but what we do is we maintain tight stop losses in all environments so that our investment methodology and our investment guidelines are adhered to. And we maintain these stop losses at a bracket level, which is for a group of equities, typically a sector, and at the portfolio level. So that's essentially key to maintaining the risk management that we promise our investors. We also, as I mentioned, the C-score system focuses on sectors for our individual picks. And we keep the sectors also within bounds. And by varying the sector exposures across a large array of industries, we're able to position ourselves with flexibility and also favorably to benefit from various positive and negative trends impacting the sectors and industries. So we try and make alpha on the positive side, and we separately try and make alpha on the negative side, and one is not typically used to hedge the other. So let's take a quick look on how a live implementation of the strategy performed. So we have a client, Crimson Black Capital of the UK, and they basically utilize our model and was able to come off profitably through the 2020 COVID crash. So the monthly return for Crimson Black Capital for Jan, Feb, and March were roughly 15%, 5%, and 7% versus the S&P that saw pretty large drawdowns. And the reason for the outperformance around this time of COVID is because with greater market volatility and dislocation, there's a greater dispersion among the various securities in the universe. And so there's a greater potential to monetize profits that are there for the taking if the model works correctly. And so that's what we sort of were able to establish. And this is, the performance of the model over the 12 months around the COVID timeframe. And see, you'll notice that in the months leading up to COVID, when the market was relatively stable, the model is not able to produce outsized performance. And the 3 months leading, into COVID and out of COVID, we saw the 3 bars that produced the bulk of the returns, so we basically go through an iterative process of reviewing on a quarterly basis to basically figure out if these algos are doing their job on a signal by signal basis, and basically, we try to keep these models honest and make sure that they are in fact adapting correctly and making the right decisions. So I'll conclude with that by saying that U.S. equity long short is one of the several strategies we offer. Another one being a managed future strategy that is trend based on the S&P 500. And we have a volatility income strategy. And for those interested, they can contact me at this number provided and email. Our website is trueriskcapital.com. And we are happy to take questions offline, if not later on. So thank you very much for the opportunity.
Wonderful. Thank you so much, Kaushik, for that really insightful presentation. There, I can see several questions already that have come through in Q&A, which we will try to get through during the panel. Otherwise, you have the opportunity to respond directly if there are very specific questions that only you would be able to answer.